7.3 Budgeting for Cash and Income. It's clearly a budget. It's got a lot of numbers in it. George W. Bush. What do budgets look like? Well, there are no set formats or rules for what should be in budgets or what they should look like. So they will be different from firm to firm, much like the rest of management accounting. As we have seen, with management accounting, there are no set rules imposed on managers about what they must do. Still, there are general patterns and ideas often followed by firms in the budgets they use. Budgets can often apply concepts from accounting that managers find useful to help them better understand and engage with the economic and business realities of their firms. In this section, we will look at what cash budgets, budgeted income statements, and budgeted balance sheets can look like. Cash budgets. The two most beautiful words in the English language are check, enclosed. Dorothy Parker. Have a look at a reasonably typical, although highly simplified, cash budget set out in figure 7.1 below. This cash budget is for Purple Chocolates, a new chocolate company establishing itself in a small building just around the corner from the Cadbury chocolate factory in Claremont in Tasmania. Have a look at the cash budget and think about what it tells you. It has various cash inflows, that is, cash expected to come into the firm each month, and various cash outflows, that is, cash expected to go out of the firm. It is about cash that is expected to flow into and out of the firm each month. Purple Chocolates is intending to launch 3 products initially: Dairyist Milk Bar, Caramello, and Hazelnut, all wrapped in the company's distinctive purple wrappers. They expect some sales will be made at its factory for cash, and that most sales will be made to supermarkets and other retailers on 60 days credit terms. In the cash budget, it is only when cash is received by Purple Chocolates that counts, not when sales are made or when the chocolate bars are handed over to its customers. Purple Chocolates will also have various cash outflows involving the purchase of direct materials, full cream milk, cocoa, butter, sugar, and a secret purple ingredient containing caffeine. Direct labour, including employing some key ex-employees from Cadbury's chocolate factory nearby, and period costs, including electricity, council rates, and building maintenance. These costs are included in the cash budget when they are expected to be paid, not when they are expected to be incurred. For example, people will work in the factory for 2 weeks before they are paid their wages and salaries for that period. Purple Chocolates also plans to spend cash to purchase new machinery in the first month when it is starting up its operations. Some indirect costs, such as depreciation on machinery, do not involve Purple Chocolates paying any cash, so these would not appear in the cash budget. Also, Purple Chocolates shareholders plan to invest new capital into the business at the beginning of the first month to help fund its activities. This also involves cash coming into the business. When we add up all the cash inflows and deduct all the cash outflows, we get the net cash flow. If this is a negative number, that is, cash outflows are expected to be greater than cash inflows in the month, this is shown in brackets. The net cash flow for each month is added to the opening cash balance of Purple Chocolates at the beginning of each month, which is 0 at the beginning of the first month, and in this way we can calculate our closing cash balance each month. The closing cash balance of Purple Chocolates each month becomes its opening cash balance for the next month. Take a little while to look at the cash budget for Purple Chocolates in figure 7.1 below. Have a careful look at it. Make sure you understand how the cash receipts from sales have been calculated from the sales budget that is also included in figure 7.1 below. Remember, the cash receipts from sales each month is calculated as that month's cash sales plus the credit sales of 2 months previously. As there were no sales before January, the cash receipts from sales in each of January and February are simply the cash sales for each of those months. We are the Managing Director of Purple Chocolates. What does this cash budget tell us? What does it not tell us? Well, one thing it tells us is that except for January, we expect the closing cash balance each month to be negative. This means we would need to first negotiate an overdraft facility with our bank. Otherwise, our friendly bank manager would be giving us a call before long, and direct debits paying staff's salaries or our suppliers of sugar and cocoa may not be paid by our bank. This would very quickly lead to unhappy employees and unhappy suppliers. This is one thing the cash budget of Purple Chocolates would tell us. What else does the cash budget tell us? Well, it tells us we expect total net cash flow for the 6 months ending 30 June to be negative $325,000. See the total column for net cash flow in Figure 7.1 above. We can also see that we expect the net cash flow from Purple Chocolates to become positive in May because of a big increase in expected cash receipts from sales in that month. This big increase in expected cash receipts from sales in May is due to an increase in expected credit sales in March. See the sales budget in Figure 7.1 above, which are paid in cash in May. This means we expect our negative cash balance to peak at the end of April at $825,000 and then start to decline. However, life usually does not happen exactly as we expect. When arranging a bank overdraft with our bank, we would need to ensure Purple Chocolates has some headroom in the amount of its overdraft facility in case the cash demands on the business prove to be greater than we expect. We would be wise to arrange an overdraft facility of at least $1 million and preferably say $1.25 million. Also, as Purple Chocolates moves forward into the year, we can compare actual cash flows with the expected cash flows in the cash budget each month. This allows us to reassess regularly the future cash requirements of Purple Chocolates in the light of actual experience. Further, cash receipts from sales are a major item in our cash budget. A key driver of this item is credit sales 2 months before, as credit sales are paid by customers in cash 60 days or about 2 months after the sale. As Purple Chocolates progresses into the year, we can keep a careful eye on credit sales each month, as that will have a major impact on our cash budget 2 months later. We've made a start. We've considered the cash needs of Purple Chocolates over the first 6 months. However, firms do not exist simply as some sort of ATM, dispensing cash at one end, the front, and having cash put in at the other end, the back. Cash flow is important. Run out of cash and you are out of business. It is as simple as that. But there is more to managing a firm than managing its cash flow. For example, we need to add value to our equity investors by providing a return on their capital invested in our firm. To do this, Purple Chocolates must earn profits. Budgeted income statements. We also need to budget for our income or profitability, which is a measure of our firm's value add to its equity investors. We do this by pulling together our various functional budgets for our firm into a budgeted income statement. Spend some time having a look at the budgeted income statement for Purple Chocolates in Figure 7.2 below. I've included the budgeted income statement for the full 6 months. I could have included the budgeted income statements for each of the 6 months individually, as we saw for the cash budget. However, to keep things simple so that you can see some of the important relationships and issues more easily, we will focus on the full 6 months budgeted income statement rather than for each month. What does the budgeted income statement tell us about the expected outlook for purple chocolates for the 6 months ending 30 June? The first thing to notice is that Purple Chocolates is expecting to make a profit of $825,000 in the 6-month period. This sounds good. Yet with the cash budget, we saw that Purple Chocolates is expecting a net cash flow of negative $325,000 in the same 6-month period. See net cash flow in the total column in figure 7.1. Is it possible that Purple Chocolates could be losing cash of $325,000 while at the same time making a profit of $825,000? How could this be? Which one should we believe? Also, we see that the expenses of direct materials, $1,650,000, and period costs, $1,650,000, are each greater in the budgeted income statement in figure 7.2 below than are the cash outflows for direct materials, $1,500,000, and period costs, $1,500,000, in the cash budget. See the total column for direct materials and period costs in figure 7.1 above. How could this be? Again, which one should we believe? Purple Chocolates pays for its direct materials such as full cream milk, cocoa and butter 1 month after purchasing and receiving them. It pays for its period costs such as electricity on average 1 month after it uses them. You can see Purple Chocolates may pay for various expenses at different times to when it incurs or uses these expenses. Also, Purple Chocolates may receive cash from its customers at different times to when its sales are made. For these reasons, its cash budget and budgeted income statements for a given period may not fully line up with each other. Indeed, this is to be expected. What this means is that managers need to keep a tight eye on both cash movements in their business and on revenues, costs and profits, regardless of when they involve movements of cash into and out of a firm. Having cash budgets and budgeted income statements can help managers do this. So why in the 6 months ending 30 June is Purple Chocolates budgeting to make a profit of $825,000 while also losing $325,000 in cash? Part of it is timing lags between cash flows into and out of a firm compared to when the revenue is earned and costs incurred. But there are other reasons for this difference. To understand more about how our budgeted cash flow and profit can be so different, we need to look at changes we are budgeting for or expecting in our firm's assets, liabilities, and equity. We will do this when we look at the budgeted balance sheet of Purple Chocolates in the next section. This will complete our look at a firm's master budget. A firm's master budget provides a future virtual world for a firm that is only one of many possible futures it potentially faces. Business is full of surprises, which is part of the captivating power of business. In the next section, we will also conclude our look at budgets by considering how accounting can help or hinder us to manage the many surprises in business that will inevitably happen, no matter how well we may plan or budget for the future. 7.4. Responding quickly to surprises. The fool of nature stood with stupid eyes and gaping mouth that testified surprise. John Dryden. In this section, we will look at the third budget in a firm's master budget, the budgeted balance sheet, and we will see what additional insights it can give us. This will complete our look at a firm's master budget. Also, it is all very well to budget and plan, but we know life and business is full of surprises. Time and again, things do not work out as we expect or budget or plan. Sometimes things work out better than we expect. Other times things turn out in ways we do not like. What happens when the unexpected happens, when things do not work out as planned? What do managers do then? In this section, we will also look at how accounting may help or hinder managers to keep track of what is going on in a firm and to quickly react to get things back on track in a firm. We will ask whether accounting can help managers meaningfully control a business and react quickly to surprises. And before we look at this issue, we will look at the third budget in a master budget, the budgeted balance sheet. Budgeted balance sheets. As well as budgeting for cash and income, a firm also usually budgets for its balance sheet items, namely assets, liabilities, and equity. It does this in its budgeted balance sheet. Have a look at the budgeted balance sheet of Purple Chocolates below. At the beginning of January, Purple Chocolates is not expected to have any balance sheet items. As at 30th of June, it is expected to have equity of $2,325,000. It is expected to have total assets of $3,325,000, involving inventory $375,000, debtors $2 million, and equipment $950,000, net of accumulated depreciation. It is also expected to have total liabilities of $1 million, involving a bank overdraft $325,000 and creditors $675,000. From the budgeted balance sheet, we can see one reason for Purple Chocolate's negative budgeted cash flow is that the firm is expecting to increase its assets significantly, particularly its working capital, debtors, and inventory. A firm's cash budget, budgeted income statement, and budgeted balance sheet can together give insights to managers about some key aspects of the short-term plans for a firm. Once a virtual world of a firm has been set up with various budgets on electronic spreadsheets, we can then change some items and see what impact this has on our firm. For example, what would be the impact on our expected cash flow and profits if we can collect our debtors on average within 30 days rather than 60 days? Or if our sales prove to be 10% less than we expect? This can help us understand some of the risks for our business in our budgets and forecasts. Short-term planning, setting budgets, and understanding some of the risks for a firm are great. But once a firm starts to take actual steps forward, in reality, things are unlikely to work out exactly as we expect. How might budgets help us respond quickly to the surprises that are a natural part of being in business? Responsibility centers. Accountability breeds responsibility. Stephen R. Covey. Many firms are large and complex. They often operate in many different markets and in several locations. They can carry out a wide range of activities and are continually changing and developing their product and service offerings in response to changes in their environment and customer demand. This size, complexity, and rate of change can make many firms seem difficult to understand. They can seem like a complex blur, a large black box difficult to penetrate and understand. Yet by breaking a business into smaller and smaller pieces, it can become easier to understand and it can become easier to measure its performance and activity. This can make it easier to hold people accountable for results within a firm and make firms more responsive to change and to ensuring managers' objectives are achieved. We looked at the idea of responsibility accounting in Chapter 5, Section 5.4. Responsibility accounting is where we break a business into different units and measure the performance of those units in terms of accounting results. These units of a business can be departments, branches, or divisions. They can be a function or an activity or even a piece of equipment. Responsibility accounting is about tracing costs, revenue or profits to individual managers or small groups of managers in a firm. We then assign responsibility for some aspect of a firm's performance to that manager or small group of managers. We establish performance measures or benchmarks which they are held responsible for achieving. We then evaluate periodically what happens compared with these performance measures and assign rewards to individuals based on this evaluation. Budgets for each unit of a business can provide a basis for responsibility accounting by regularly comparing actual performance with budgeted performance. In this way, managers have more of a chance to ensure people in a firm are doing what managers want them to do, and that surprises, which invariably occur in business, can be responded to quickly. Yet this whole idea of responsibility accounting depends not only on simply assigning responsibility to bits of a firm to individuals or small groups. It also depends on being able to measure and evaluate performance of bits of a firm and to connect this evaluation of performance meaningfully to individuals who can actually do something about that performance, who are in some ways the drivers of that particular aspect of a firm. We will now look at how accounting can help or hinder managers to hold individuals meaningfully accountable to achieving outcomes for aspects of a business that is in line with the overall objectives of a firm set by managers. Measuring performance. The purpose of measuring the performance of responsibility centres is to reward people who perform well and to punish in some way those who do not. What happens in firms and organisations that do not effectively measure and reward performance? Well, typically an increasing number of individuals in those firms can develop an entitlement mentality where they think the firm owes them a living. Self-serving practices by individuals can easily develop, unrestrained by any effective mechanism to adjust individual behaviours to conform to the overall objectives of a firm set by managers. This can lead to individuals over time becoming dead wood, like dead branches in a tree that are using up space on a tree but contributing little or nothing to the life and growth of the overall tree. Many people see this sort of thing that can develop in firms and say, well, we better assign responsibilities, measure and evaluate performance against established targets, and then meaningfully assign rewards and punishment to individuals. But what happens if we do this, when we measure and reward performance in a firm? Well, it can lead to many consequences that are not intended and generally not liked by managers who set up the performance management system in the first place. The measures of performance can encourage behaviour consistent with the goals of a firm, but equally they can all too easily encourage behaviour inconsistent with the goals of a firm. How could this be? Think back to the example of the baggage handlers at Heathrow Airport in section 7.1. Great care needs to be exercised in setting performance measures and targets. A lot of careful thought needs to be given to how the performance measures are connected to and support the objectives of managers in a firm. This is critical if the performance measures are to help align people's objectives with those of the managers of a firm. They can all too easily encourage behaviours that are disconnected from and indeed in conflict with the objectives of managers, such as the baggage handler running with the first bag and getting it onto the baggage carousel, regardless of when the other bags of passengers find their way onto the baggage carousel. Another key to measuring performance is to ensure that the people whose performance is being sought to be influenced by the performance measurement can indeed meaningfully affect or change the performance measure being used. This does appear to be obvious, However, it is not unusual for this to not be the case. For example, a management buyout MBO of various Australasian operations of McKinney plc included Methven, a New Zealand tapware business, as a relatively small part of the larger Australasian group. The remuneration of the senior management team of Methven was significantly affected by the overall performance of the McKinney Australasian group. Yet the senior managers in Methven could only meaningfully affect the performance of Methven, which had limited impact on the overall group. They had little or no ability to influence the performance of other businesses in the group. As it happened, the performance of Methven, while part of the McKinney Australasian group, was strong, yet the performance of some other businesses in the group did not perform as well. The remuneration of senior managers of Methven was being significantly influenced by the overall performance of the McKinney Australasian group, even though they could only meaningfully affect performance of one relatively small part of the group. What was this approach to performance management achieving? Well, if anything, it was discouraging for the senior managers of Methven rather than motivating them in a positive way. The McKinney Australasian Group then sold Methven to another MBO consortium made up of managers of Methven and private equity investors, which ran Methven as a standalone business. The senior managers of Methven were now held accountable for the performance of Methven itself, which was something they could meaningfully influence. Methven subsequently performed strongly and was floated on the New Zealand Stock Exchange. It was then acquired by GWA Group, an Australian listed company, and it became part of a larger group again. When measuring performance of responsibility centres, whether whole companies, divisions, a small work team, or even a piece of equipment in a firm, it is critical to ensure the individuals being held accountable for the performance of the responsibility centre can meaningfully affect or change the performance being measured, and that the performance being measured is clearly and carefully connected to the overall objectives of the managers of the total business. Balanced scorecard. Of course, there is a lot more to business than its accounting numbers. In the same way, there is a lot more to our personal lives than the dollars we earn from our labour and from our financial capital we may have invested. There is a lot more to our personal lives than the list of financial transactions in our monthly credit card statements. Yet the financial numbers of our credit card statements can tell us a lot about us. Money spent at upmarket clothing stores in Queen Street Mall at Brisbane, or on airplane flights, or at restaurants at various holiday locations in Fiji or at Port Douglas in Queensland, Australia, or perhaps money given in donations to Mary Potter Hospice in Wellington, or to World Vision, or to cancer research, or perhaps money spent online gambling on Sportsbet. Our monthly credit card statements can tell us a lot about us. In the same way, financial measures in business can tell us quite a lot about a business. If we combine financial measures with non-financial measures of a firm's operations, this might help us better connect with a firm's economic and business realities and help us make more realistic assessments of performance. This is the idea behind balanced scorecards, which has become quite a popular tool of management. Typically, a balanced scorecard can seek to support managers in a firm to measure and assess performance from a financial perspective, for example, through accounting measures of financial performance, from a customer perspective, for example, through measures of customer satisfaction, from an internal business process perspective, for example, through measures of delivery of products to customers in full and on time, and from a learning and growth perspective, for example, through measures of employee training and employee satisfaction. However, balanced scorecards can easily be applied poorly in businesses and degenerate quite quickly into relatively meaningless tick-the-box exercises. Nevertheless, if intelligently and thoughtfully applied, Balanced scorecards can usually broaden the measures of performance from simply short-term financial measures to include measures of relevance to the more medium-term aspects of a business. Conclusion. Managers need to lead their firms in the short term to ensure they take the appropriate next steps on their longer journey. We've seen how budgets may help or hinder managers to do this. Budgeting is common in many firms. The reason why managers use budgets to help them manage firms are to support short-term planning, to coordinate different aspects of a firm in the short term, to assist clear communication within a firm about the short-term objectives, to support delegation of decision-making, and to help motivate staff. If used well, budgets have the potential to do all these things. But in practice, there are many traps for managers in using budgets effectively in a firm, and many of these potential benefits can easily prove illusory. The key issue is that all these potential benefits of budgets involve the effect accounting numbers and budgets can have on people. And people, as we know, have their own intentions and motivations independent of those of management. We saw there are potential benefits of participative budgeting, which involves including many people in the process of framing budgets. We also looked at an overall master budget for a firm, cash budgets, budgeted income statements, and budgeted balance sheets, and the role each can play in the short-term management of firms. We saw the role budgets can play in measuring the performance of responsibility centres and to help managers respond quickly to surprises, which are an inevitable part of business and indeed of life. The short term is important for firms. It is the next step on a long journey. Budgets can help or hinder managers in leading their firms in the short term. A key role for managers is to make decisions, to take charge, and to take the lead. Now, decisions made by managers can affect not only the short-term performance of a business, they can also have long-term implications for firms. In the next chapter, we will see how accounting can help or hinder managers make effective decisions for their firms in both the short term and the long term.